Hi, my name's Henry Conway, and this is my partner, Landon Blinko. We're both high school students from Trinity High School in Louisville, Kentucky, and today we're presenting our long thesis on Amphenol Corporation with a price target of $185 per share, which represents a 25% upside. This opportunity is really easy to miss if you're not deeply engaged in the interconnect hardware space. Though, through our research, we believe that Wall Street is fundamentally mispricing both the scale of AI content growth and the margin expansion opportunity. Let's dive in.
Our investment case rests on three main thesis points. First, Amphenol has a widening competitive moat. Its co-development practices with customers like NVIDIA, its dominant market position, and the rising electronics complexity across all end markets are all driving factors. Second, Wall Street is underestimating AI content growth over the next few years. The street expects roughly 40% more content growth for a server rack. However, our analysis shows 80 to 100%. Third, the non-AI business is a 15% organic growth engine that's being completely ignored. Amphenol's defense, industrial, and automotive sectors are all providing diversification and growth. Amphenol is the dominant player in high-speed connectors and interconnect systems. Headquartered in Connecticut, the company operates globally with a vertically integrated design and manufacturing capability. Amphenol reports in three segments: communication solutions, harsh environment solutions, and interconnect and sister systems. The company also utilizes a very decentralized structure, allowing the successful integration of over 135 acquisitions over 92 years, consistently delivering 5 to 8% greater margins after acquisitions.
So our first thesis point is on Amphenol's moat and why it's widening. So Amphenol has four main competitive advantages. The first is a co-development lock-in with their clients. So Amphenol's engineers help their clients design their chips around their connectors. So switching will require re-engineering the entire platform. And then second is Amphenol's dominant market position. Amphenol is really the only provider that has the scale and speed to meet large producer demands. This drives their margins to be the highest in the industry at roughly 35%. And then third is their disciplined M&A playbook, what Landon touched on earlier, which includes 135 successful acquisitions. And then fourth is their reliable history. As more and more companies are beginning to sell to Amphenol, these company owners want to know that their life's work is going towards a stable enterprise, and Amphenol's history shows that.
What's driving the moat expansion is three main things. In AI, as chip complexity rises, Amphenol's design expertise becomes more valuable. AI connector growth requires exponentially more bandwidth per GPU, and technical demands are increasing faster than most competitors can keep pace with. In automotive, sensors like cameras and radar are becoming safety standards across all vehicle types. Once the designer is chosen, the production cycles lock in for the next 5 to 7 years. In defense and industrial, most applications have rising barriers to entry. As geopolitical tensions rise, defense budgets are increasing. Overall, as electronics get more complex everywhere, the gap between Amphenol and its competitors widens.
So now for AI's impact specifically, so we believe AI expands all four of the moat drivers simultaneously. It deepens the client co-development relationships with customers like NVIDIA. It widens the performance gap between Amphenol and commodity competitors. And then as each generation gets more complex and requires more interconnects, the content growth compounds. The primary risk is revenue concentration in 4 to 5 hyperscalers. If any single hyperscaler were to cut AI spending, that impacts Amphenol directly. But when we weigh the opportunities against the risk, AI is a strong net positive, and the risk is offset by the non-AI sectors of the business.
Now, we're going to transition into current events in our second thesis on the AI chips. What's unfolding right now is NVIDIA is transitioning from their current NVL72 chip architecture to their next generation NVL144 architecture. When sell-side analysts model this transition, they're expecting about 40% more Amphenol content per rack. Their logic being that if you're roughly doubling the GPUs from 72 to 144, you'll need proportionally more connectors with around 40% total content. On margins, Street expects that as AI volumes scale and more racks get deployed, competition will intensify. Other connector makers will invest to catch up, and Amphenol's pricing power will erode with greater production volume. They also say that AI tailwind is already priced in with the non-AI business, serving as diversification.
So now for our own analysis, which shows that the street is underestimating what this rack transition actually means. So we expect 80 to 100% growth compared to the street's 40, and this is why the street's math is wrong. So first, the math is nonlinear. NVL72 has 72 GPUs, while NVL144 has 144 GPUs. And while that is double the interconnects, these interconnects don't scale linearly with GPU count. In a system where every GPU talks to every other GPU, the number of connections grows exponentially. We found this out by researching the rack blueprints and talking to other connector analysts.
Let's think about this in another way. Take a room with 10 people. They all need to shake hands with one another. Wall Street is picturing this as 10 total handshakes being made. In reality, it would be closer to 45 total handshakes, since it scales exponentially. Here, the people are the GPUs and the handshakes are the connectors. This just goes to show the scale of this new Rubin chip.
And second, power delivery scales faster than GPU count. NVIDIA's Rubin chip runs at a much higher wattage than previous GPU generations. So again, that creates exponential power delivery requirements.
Now on margins, we expect 200 basis points of expansion as Amphenol is the only provider with the technical and manufacturing capability to meet Rubin's performance specs. This gives them premium pricing power. And with higher volume products as a greater percentage of total sales, margins increase by default.
And finally, on timing, this is a very easily trackable catalyst. Once Rubin ramps up volume production in the second half of 2026 through the first half of 2027, Amphenol will report their first full quarter of the Rubin earnings, and this will likely be Q1 or Q2 of 2027. And their revenue and margins will vastly beat the street's expectations, and the earnings and estimates will jump 10 to 15%. Analysts will then re-rate the stock, and the AI growth will get repriced. Okay, so our third thesis point is on the non-AI part of the business. So in quarter 3 of 2025, non-AI grew 15%, and here's why. So defense is seeing double-digit sustained growth due to rising NATO tensions and the need to modernize our military or other people's militaries. Industrial automation is becoming a production standard, mainly driven by labor shortages and wage inflation. And then automotive ADS expansion is happening across all vehicles, not just EVs. We're seeing economy cars have a rise in cameras, radar, and emergency braking. So the street is treating this as diversification, but it's actually 10 to 15% growth in case the AI floor falls out.
On environment social governance, Amphenol targets 50% renewable energy by 2030, and it recycles over 2/3 of its waste. Their decentralized structure, which is 135 autonomous units, allows freedom to run businesses locally under the philosophy, think globally but act locally. We see no ESG risk.
Okay, so on valuation, we use a collection of metrics in a 30-year DCF. In our bear case, we assume the street is completely right, and the stock goes down 13% to $125. In our base case, which we modeled for, we assume 80 to 100% AI content growth and 200 basis points of margin expansion. Here the stock goes to $185 with a 29% upside. In our bull case, everything goes better to expected, and the stock goes to $230, representing a 74% upside. So you're looking at a limited downside compared to a 29% upside in our base case and 74% in our bull case. There's a 2.2 to 1 risk reward, which is very favorable. We then researched a 30-year DCF model to determine the intrinsic value of Amphenol. The DCF was structured into 2 forecast periods and included assumptions tied to AI revenue and the NVL72 rollout. This informed our price by modeling how much cash Amphenol would generate over the next 30 years based on the AI content growth we expect. When you discount all that back to today, you get an intrinsic value of $185 per share. So there are 3 key risks where we could be wrong. First, if the company slows spending on data centers, clients like NVIDIA could see a stock drop, which could affect Amphenol directly. Then second, an unexpected market shift to what are called co-packaged optics could reduce Amphenol's share of connectors. And then third are risks in certain M&A transactions, for example, the CommScope and Trexon acquisitions. However, Amphenol's long proven track record in the M&A makes us less worried about this. So finally, for our research process, we conducted calls with 2 main people. The first was a manager at Amphenol and is the person that's on your screen right now. He gave us insights into Amphenol's M&A team and talked a lot about Amphenol's decentralized structure. Second, we called a sell-side analyst, which viewed our same contrarian stance against the market and especially helped with Amphenol's AI chip transition. So both proved valuable in our research process. So with that, we see a clear path to high teens returns with a specific 12 to 18 month catalyst. This is a quality business with the widening moat, and in our opinion, is the fastest growing company that no one has ever heard of. We look forward to your questions and feedback.